Welcome back to the Compassionate Capitalist Show. We're going to, I'm really excited because I have my guest today, Rashaun Williams, is a true embodiment. I'm going to embarrass him for a second. He's truly the embodiment of what we've referred to as self-made. Okay. I dare say a millionaire, but he is humble today in his success as he is in his beginnings. He probably wouldn't claim that. But as a kid from the south side of Chicago, where money, lack of it, was a daily topic, through his fierce determination to turn money into a tool to not only master, but as a tool to build his own wealth while also helping others preserve and protect their growth. He's a Morehouse man, summa cum laude graduate, worked as an investment banker on Wall Street, focused on tech, direct to consumer media companies with an emphasis on diversity in markets as well as founders that they backed. He has started and served as a partner in several firms. Queensbridge Venture Partners, which I just discovered, has the infamous entertainment icon Lil Nas as part of that. MVP All-Star Fund with 4 funds that he's raised over there and deployed, and the Value Investment Group. So he's invested in successfully exited notable companies such as Coinbase, Ring, Lyft, Robinhood, Dropbox, 150 investments with 40 exits. And that's 50% increase of the investment since the last time we recorded an interview and double his exits. So in our last talk, we focused on his institutional and his personal investment philosophy. And the link to that broadcast is in the show notes. I republished it a few weeks back as I was preparing for this, and I just thought it had I had listened to it, and I just thought it had such great information and really something that, as I've been rolling out my own angel investor education and trying to bring in people with not only that are on the up and growing, like their future wealth, so millennials or people that aren't yet accredited, but also executives that are fully accredited with lots, but just never have really looked at angel investing and trying to meet them where their risk tolerance is. That's why that late stage philosophy was so critical on that. And I use it and talk about it all the time in my training. I'm rolling out this digital course here in the next few weeks. So that, please go and watch that. The new name is called From Wall Street to Late Stage Investing, a roadmap for predictable returns with Rashaun Williams. And the key takeaways was building a balanced portfolio, well-performing portfolio. It's good to build diversity based on stage and industry. And when going into earlier stage deals that are potentially more angel stage, seed, and Series A, due diligence is always important, but even more so at that stage to truly understand the potential impact in the market. So those are those key takeaways. All right. So today we're going to catch up on this incredible progress and accomplishments since we last spoke just a few years ago. And I'm so honored that Rashaun has agreed to come back and talk on the Compassionate Capitalist Show, because after all, this is a few quotes on being self-made. Okay. So I have to just throw these in here. After all, it's what we've done that makes us what we are. That's Jim Croce, because people, wherever we are today, it is the sum of our choices and actions, and a little bit of good luck and timing built into it. But right,
Sure.
we are all self-made, but only the successful will admit it. That's Earl Nightingale. And my main goal is to be a self-made man and have control over what's mine, and that's Kevin Hart. And that is really kind of puts right into where we are and what you're doing right now that we're going to get to. But as I said when I first brought you on, Rashaun, let's get caught up on what's happened since before, when we spoke before 2019 was when we did our last recording. That how it seems like I was telling you, it seems like I remember that conversation and first meeting you, and it does not seem like it's that long ago.
Right.
2020 is like a lifetime of experiences in 1 year for most people. So, that was before COVID. It was before the George Floyd and Breonna Taylor murders that opened up this
That's right.
door for a national reckoning of systemic racism. And now we've got all kinds of other fights going on about that, right? And what does that mean? And should we educate people on those kind of things and history and how to should we rewrite history and not rewrite history? And the huge gaps that over the last 50 years that we've seen really collectively realize that so much more needs to be done within the criminal justice reform system, but even more for the wealth gap. Not only the household that it was, I realized it in 2020. So a lot of this is my own self realization that there's a 10x gap between the white and black households of
Yep.
their household wealth, right? And that isn't something that happens in a year or 2 years or 10 years. That's an accumulation. And
Correct.
also even what people are capable of generational wealth when it comes to owning property, understanding investments. What is it that you invest in? That's something that I really focus on when I talk about, my courses are designed to help women and particularly people of color to jump a wealth gap, because investing in entrepreneurs was illegal and a secret for so many people for 80 years, right? And
Mm-hmm.
all of the myth, and I think you even we're going to get into talking about your new thing with helping athletes,
Entrepreneurs.
right?
Mm-hmm.
With your antimatter, but even then, and I don't want to steal my thunder for down the road, but you talk about the wealth managers that typically are advising these incredibly wealthy athletes that oftentimes don't come from a history of wealth. So how they have been spending it when they were making money, that whole thing, right? It's a whole different way of thinking. And that's the same thing that I'm countering, and or not saying, but it's, I'm still addressing the myths out there about how like real estate and traditional stocks as being the best things to create wealth, and that there's no risk. There's risk in everything. It's all a matter of how you manage your risk, right? So during that time, right, we also had an inflation. We had, interest rates had been artificially kept low for longer than they should have. So we finally
Yep.
had to raise interest rates. Cost of money, recession, completely changed things, right? So a lot of stuff has happened in those few years since we last talked. So as a proud black man, self-made man, and a money man, tell me and my listeners, in those what put fear in your heart and kept you up at nights as you reflect back? You're on the other side. Things, I mean, we're still not completely out of it, but we're definitely on the it's everything is ticking up. So, when you're in the middle of 2020, 2021, what put fear in your hearts, and would you
Well,
like
first of all, thank you so
drew
much for
upon?
having me back. I'm very excited to have this conversation. I don't know what you've done since 2019, but you literally just named all the things that I'm super knowledgeable, passionate, and obsessed with that we're going to
Hey.
talk about today. So
Good.
I'm like over here getting super amped up. I'm like, oh my God, where should we start? Let me start with the most important thing that's happened since 2019, and then I'm going to tell you what keeps me up at night. Since 2019, I'm now married with 2 kids. So my son was born in
Wow.
2018, right before we spoke. My wedding had been postponed because of COVID. And then we decided to
Wow.
have a daughter. Her name is Callie, and my son's name is Cooper.
For those that are
So,
watching, he's showing pictures of his beautiful family on here. So this is terrific. Thank you so
yeah, so
much.
we have a lot of fun, and that's been a
Congratulations.
huge change in my life. It's the one thing that I've wanted my entire life that money couldn't give me. And that thing is stability, right? So now I have what I've been looking for ultimately. Now let's dive into it. Lot of different things to talk about. Oh my God. The biggest thing that keeps me up, that has been keeping me up, I would say since COVID happened, and then since the market repriced. And I've been on CNBC like 15 times talking about
I
this as
know.
well.
I've seen some of that. I'm like, wow.
And it's literally the lack of information, the fear-driven lack of investment strategy, and the overall resetting of people's financial thermostats every single time a big catastrophe happens, a black swan,
Yes.
right? Everybody hits the reset button instead of just sticking with their strategy. Now, this is the 98% of the population.
Hmm.
There's 2% of the population, which I am now included in, that has been waiting for a market repricing, whose portfolio is structured to take advantage of it and who are going to come out of this situation wealthier than they went into it. So how do we get the fear levels down and convince people to buy low, sell high, not buy high, sell low? How do we get people a strategy that contemplates a repricing every 8 years? And how do we get them to implement that strategy where they take advantage of it just like an ant prepares for the winter in the summer? When you look at ants all year long, what are they doing? Carrying food to the ant hill, right? All summer long. They're just busy carrying food, storing it away. If an ant can prepare the winter in the summer, then surely we can prepare for a recession in a bull market, right?
Yeah.
So that's the thing that keeps me up the most. And to make it even worse, Karen, there are people who are taking advantage of people with bad information. And it has become more rampant since we spoke in 2019. During COVID, a bunch of these fake gurus took all of these hard earnings people's refund checks and government checks and paychecks and selling them fake plans and get rich quick schemes. And that has made it even worse, where people who are on the fringes, who are looking for that last line of information, get taken advantage of. So I haven't spoken on anyone's podcast to anyone since you. And I was so happy that you reached out, because I feel like you're one of the few real ones. I feel like the others out there just want quick headlines and want gimmicks and want get rich quick. And I have to be very careful who I associate with, because it winds up legitimizing them, right? So there's so much to discuss, from late stage to what strategy is, to what's happening in the public markets, what's happening in the private markets. And I would love to explain to you how my portfolio is set up and how late stage is a part of that. And creating and maintaining that wealth is something that we should all be thinking about even before we have it. And that's the important.
There's a good one.
Yeah.
Okay.
So you tell me where you want to start. I'm happy to start anywhere you want.
I appreciate that, what you just said, because it is, I mean, I'll just say, because it took me a while in that time since we talked to, I was obviously promoting my book, but I didn't understand how to turn that into something that was digestible for people. I didn't truly appreciate how deeply rooted the myths of some of these traditional investment strategies, and it took me a while to unpack it, like really get down into there. And the whole idea that, one, it's where you hear it, so breaking through the noise is a challenge.
Yeah.
And two, the other piece of it was has been just as prevalent. So, like, for example, I get these objections, right, about investing in private companies, and because everybody thinks about only public companies because that's what they know and what they're most familiar with, and on real estate. And if you don't outright own the real estate or playing at a higher game, owning real estate can actually be highly risky, because there's always repairs that have to be done that will wipe out whatever little income you're making on it, in a year's time. And because I have one house that I inherited that I have a note on, and one that I don't, and so you can manage to it, right? And one I just own outright, like whatever, and one I co-own. So it's like you've got, they're all performed differently. So I've had sort of like the hindsight of understanding that, and thinking about then, as interest rates went up, people that were on the track of always, oh, I've got to invest in real estate. That's the way to create wealth. Well, 50 grand might have been able to get you a fixer upper, pre 2020, but not anymore. You know what I mean? You can't touch unless it's way out in the sticks someplace, and the only thing you're only going to be able to rent it for $1,200. So whatever it is, you're still not making money on it, right? And
right.
So that myth. And then, well, I know you invested in Robinhood, but even that whole thing where that sent the market, like you say, when you said catastrophic stuff or things that happen that like completely outside of somebody's control. So they believe that the stock market is their thing. They freak out because it goes up and down like it always does on factors outside. They spend time like picking a stock that company's performing fine. It has nothing to do with the company. It's just other factors that have caused this, that market segment to go down. Right. And then you bring in crypto. Right. And so all these people that potentially could be learning about getting, baby steps into angel investing with crowdfunding, and could be learning about how do you invest in innovation. That's the buy low, sell high, right? It's the
Mhm.
wholesale versus retail,
Yep.
right? But they'll jump on this crypto bandwagon. And I was trying to figure out why it was and why people still have so much, like when it comes to investing in entrepreneurs as private endeavors. Why is that still got all of this stuff on it? And then I realized, well, unlike unlike like you can't track angel investment or private companies. There's no chart out there that's showing the markets like there is with stock market or real estate values or even
Yep.
crypto, right? You could go out there and there's really not a lot of learning curve to get involved in crypto. A lot of people just,
Yep.
jumped in on it. And then you also got people like Fran Tarkington and big major people on Super Bowls, Coinbase. I even did the QR code during the Super Bowl,
Yep.
ad and opened up a Coinbase account, right?
Yep.
And so,
Mhm.
when you got that kind of stuff, but nobody's advertising, oh, learn
The
how to
risk.
invest in private companies before they go public or get bought, right? And um, so that was where I had to kind of get my head around understanding that and the challenge to get through that. I know what you just said about planning ahead, thinking about it, where you are in your journey and getting your financial IQ together. And then also, I love the ant analogy because that is so true. And so few folks, the financial plant managers or the regular traditional financial wealth things, I realized when it came to angel investing, if somebody came to them, like they had a deal, they'd seen a deal, they'd be like, oh, this is kind of interesting. What do you think? Well, unless they were an investment advisor, that was just a salaried kind of a thing, they, because of fear of losing their license, whether that deal was a good deal or not, they would not advise the company on it. They would say, oh, no, that's too risky. Oh, that's, you should look at this product that my company is selling, because that's what they had to do. You know, they
Well,
could
Karen,
sort of do real estate some because real estate's not a securities. And so it's like that. I had those aha moments in the last year. And, I've been involved in angel investing for 20 years and wrote a book on it 5 years ago. And that just came to me. So if it just came to me and all that stuff, imagine what it is for that other, 90% that's out there in the world that, you know, and so with that, let's get the next question. What gives you hope then? What gives you hope, Rashaun?
what gives me hope? I'll give you four things that give me hope. The financial advisory, this is thing number one. The financial advisory system works very well for 99% of the population. And those are people who retire at 65, who spend $50,000 a year when they retire, and they live another 5 to 10 years. You can put your money in the S&P 500, which has been averaging 10% returns the last 100 years, and it will serve you very well over 30 to 40 years. You max out your 401k and you put $20,000 in per year from 25 to 55, you'll have $2 to $3 million, right? You take a kid who's just born, like my daughter was born 2 years ago, and I put $500 in her account every single month, her UGMA account. By 21, she'll have $400,000. If she keeps putting 500 in, by the time she's 55, she'll have $10 million. There's a reason why capitalism is the economic system that we're using, and
Yeah.
that we keep trying to force other non-capitalist societies to adhere to it so we can keep expanding to constantly get the earnings growth that's needed for the S&P to continue to produce those returns. So I'm very optimistic for the 99.9%. As long as you
Okay.
understand that your financial advisor, there are two types. There's a financial plan, there's a RIA who gets paid a fixed fee to give you advice and create a portfolio. And then there are brokers at the big firms like the Morgan Stanleys, the Citis, the JP Morgans, who are licensed to sell you stuff. That's different, right? And then you have a certified financial planner who just creates a plan, right? And you pay him or her for that plan. So if you understand that that's what their job is, you would understand why they would say no to real estate that is too risky, or why they would say, no, don't put your money in a private business, put your money in something liquid, because they don't
Right.
get paid for that private business. They don't understand it. They're not qualified to do it. And in fact, they can lose their license if they recommend it. It's called selling away.
Right.
If you understand the game, it won't be a problem. The way that I like to look at what I do is I'm more of a nutritionist, where a financial advisor is a restaurant or a waiter. A
Okay.
nutritionist will help you figure out what type of plan you need to meet the dietary restrictions you have to meet the physical fitness goals you want, right? I don't
Very
care
good.
where you go to get it. You can go to real estate, private businesses, stocks, bonds. It doesn't matter to me. I don't have anything to sell. Where a financial advisor is like a waiter. Sir, on the menu today, we have fine cut steak from Montana, right? And if I go to them and say, I would like shrimp scampi, they'll laugh me out of the restaurant. We don't have shrimp on the menu, so, right?
Okay.
And then if that
Okay.
waiter goes and gets me shrimp from somewhere else, he'll lose his job, right?
Yeah.
Financial advisor. So that's the first thing I'm optimistic about. It
Okay.
works for most people. Now, the second thing I'm optimistic about is people are finally figuring out the difference between the private market and public market. You just mentioned something that was fascinating to me, that people say, oh, it's too risky. And then right after that, you said, but then a stock in the public market trades down and no one knows why. So people have figured this out. And I was just on CNBC talking about this. In the public markets, so every business that has a value, and all businesses have a value. There's no such thing as a bad investment. It's just bad prices, right? The value is based on two main factors: fundamentals about the business and technicals about the business. So fundamentals will say, what's the compounded annual growth rate of revenue? What's the EBITDA of the business? What is the multiple of that EBITDA? What are the precedent transactions, right? What's the overall market sentiment? How is the industry trading? Software companies trade at 10 to 20 times revenue, where a service company trades at 3 to 5 times, right? Those are fundamentals based on the financial performance of the business. Then there's a thing called technicals. To give you a spoiler alert of what technicals are, crypto, it's all technicals, no fundamentals. It's just speculation from buyers and sellers. Everyone loves it. Price goes through the roof. There were cartoon pictures of monkeys selling for $25,000. It's called
Right.
NFTs,
Right.
right?
Yeah.
Because
Yeah. Yeah.
everyone thought it was going to be worth 50,000, right? Everyone's jumping on the crypto because Elon Musk sends a tweet. Hey, this is the thing. Everyone's looking for a quick fix. That's all technical. More buyers than sellers drives the price up. When there are more sellers than buyers, drive the price down. Now, add that to the stock market fundamentals. You can have a company like DraftKings, which I invested in. DraftKings went public via SPAC, went from $10 to $50. Revenue has doubled and tripled since then. The stock is down 80 to 90%. How is that possible? The fundamentals are twice or three times as good and as strong. Online sports betting is legalized in multiple states now, way more so than it was when they went public. How can the stock be down 80 to 90%? Fundamentals. You have the overall economic situation, which is looking very dicey in spite of the S&P being up 19%. People are super worried about the economy based on the things that you said earlier about inflation and interest rates. I mean, the war happening all around the world, like all of the geopolitical issues, right? So if you remove the technicals from the stock market and you only look at the fundamentals, guess what you have, Karen? Private companies. This is why I invest in private companies, because I only invest in things that I understand. When you have hedge funds shorting public stocks
Yeah.
just to make a quick buck, when you
Yeah.
have the stock market going up and down with no rhyme or reason whatsoever, just based on trading volume or the lack thereof, me as a fundamental investor, I just can't understand it. Now, if I'm holding on for 20 years, it'll catch up. right? But if I'm looking at this thing on a month by month, quarter by quarter, year by year basis, the stock market, I just don't understand it. It's really just gambling, in my opinion. It's not safe. No one can predict this performance. No one can tell me why the stock is up or down because of all of those things. Now, with that being said, let me go to the third thing that I'm optimistic about. I finally learned after 20 years how rich people use the stock market, and it's not how you think. All right.
Okay.
Okay.
Here's the big secret, big reveal.
Rich people use the stock market to avoid taxes and to buy private businesses. That's it. Let me give you an example. You mentioned that I was an early investor in Robinhood. So I put 50 grand in Coinbase. It turned to 20 million bucks through my Queensbridge fund with Nas. And then I did 25K in Robinhood and it turned into $12 million. This is in 8 years. So I invested in a bunch of other companies too, like Rain, Casper, PillPack, Dropbox, Lyft. They all had exits, either IPO or acquired by Amazon or something, right? The ones that got acquired for cash, I owed a tax bill. The ones that went public, I got exchanged shares in a private company for shares in a public company. So it merges into my stock portfolio. If I sold $20 million worth of stock, I owe $5 to $6 million in taxes. So what do people like Elon Musk, Mark Zuckerberg, Jeff Bezos do? Something called buy, borrow, die. Have you heard of that?
Oh.
Okay.
I mean, not in that way. Let's see.
So buy, borrow, die is a strategy that rich people use. And instead of me selling that stock and paying $5 million in taxes, I borrow against that stock and I pull $5 or $10 million out. The interest that I'm borrowing against that stock is tax deductible. So I'm actually getting a tax deduction and I still keep the stock, which is going to grow over the next 10 years. And guess what? When the stock doubles and triples in the next 10 years, I borrow more and more. What do I do with the money I borrow, Karen? Here's my favorite part. I buy private cash flowing businesses or real estate. After 1 year, I refi that business, take out my line of credit and pay it back down. And I use the business credit because I've owned it for a year now, right? So if I bought a business for 5 million, a plumbing business for 5 million, I take the cash flow from the business, I go get an SBA loan or a regular bank loan now, and I pay my line of credit back down to zero. If I bought real estate, a multifamily, 10, 20 unit, right? I can go and refi that and get a mortgage on it now, right? I refi my line of credit now. Now my line of credit is back down to zero. And guess what I do to it again? Go buy another business over and over and over. So I get access to my capital without paying capital gains. This is why the tax rate of the wealthy is so low. They don't sell anything. They borrow against it. And before interest rates went up, it only cost me 50 basis points from Citi Private Bank to borrow against my stock, 50 bips. Now it costs me like 5 or 6. But still, I'm making 20% annual cash flow from the businesses that I acquire. And then I just refi them out. So once you learn how to use stocks, now you're not so concerned the stock market is up 10%, down 20%. You're not selling it anyway. What you care about is over the long haul, over 10 years, that is going up or is the same price. And that you have a relationship with a bank where you can borrow against it to acquire cash flow things. Now, the last thing I'll tell you that I'm excited about is I also learned something, and it took me a while to figure it out. I would say when I spoke to you in 19, I knew it. I just didn't have the data to prove it. Okay. So I'm going to show you do you mind if I share my screen and just show you the data to prove it?
Go ahead.
All right.
Let's do it.
So it's a little dramatic, but I'm going to
give you
give me some permission. Make me like a host or owner or something like that. Yeah. If you go to my name in the participants and then click where it says more, it should say make host.
Go.
No, it's not doing it.
Oh, wait, let me make it a co-host because I don't know.
Yeah, there you go.
Mess up my
yeah, permission. There we go. Okay. So I'm excited to share this one with you. All right. So stick with me for a second. I learned 10 years ago, but I finally put together the data to support it. This is what rich people know that no financial advisor will ever tell you. And what it is that the wealthier you become, the less you need a financial advisor. It makes no sense when you hear it for the first time, but let me prove it to you with data. Okay. So look at this chart. Okay. Try to zoom in one more time. There we go. So Karen, on the vertical axis is your net worth from 10,000 to $1 billion, right? On the horizontal axis is what you own, the percentage of your assets that are in different asset classes at different net worths. So you mentioned something earlier to me that really piqued my interest. If you are a net worth between 10,000 and 100,000, guess what your net worth is largely comprised of? The orange stuff. What's the orange stuff in this chart? Your house, your cars, your retirement account, and then cash. But what if your net worth is 100 million to a billion? And at this point, when I transitioned from my net worth being 10,000 to high 8 figures, my portfolio started to look like this. It's largely in this blue stuff. So people who are worth 100 million to a billion have 80 to 90% of their portfolio in blue stuff. And in this chart, blue stuff is ding, 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 private businesses and real estate. Karen, what percentage of your portfolio is fixed income? If you're a billion, it's 3%, right? So if 80% of your portfolio is in private businesses and real estate, and financial advisors only do stocks and bonds, then the richer you become, the more you own private businesses and real estate, therefore the less you need financial advisors. But who do you need if the vast majority of your portfolio is private businesses and real estate? That's where family offices come in. And that's one thing that I knew, because when I worked on Wall Street for 12 years, all of my clients had family offices. They all owned private businesses and real estate. Every team owner in the NBA, NFL, every billionaire I know owns private businesses and real estate. I don't know a billionaire whose portfolio is stocks and bonds. The majority of it, right? And since we're talking about Black people, I often ask some of my athlete and entertainer clients, I say to them, and I'll stop sharing this, I say, name the richest Black people in America. And they say, Rihanna, she's a billionaire, Kanye West, Jay-Z, Oprah, Tyler Perry, and Robert F. Smith. I say, okay, so Rihanna, she made her money from a makeup company called Fenty, right? She was a recording artist for years. She became a billionaire when she started a makeup company. What if you took the makeup company away from her? How much would her net worth drop? 99.9%. What if you took Yeezy and all of the real estate away from Kanye? What would happen to his net worth? Drops 90%. What if you took Tyler Perry Studios and his mega $100 million mansion away from Tyler Perry? What if you took Oprah and OWN and Harpo away from Oprah Winfrey? What if you took Rock Nation, all the alcohol companies, and all the real estate away from Jay-Z and Beyonce? And what if you took Bad Boy and Ciroc and De Leon, which is already happening, away from Puff Daddy? Like, what happens? Their net worth, it don't drop 5%. It drops 95%. And then the last thing I tell them, some of my LPs in my VC fund are team owners. And one of them owns a Major League Baseball team in Texas, and he's worth $2.3 billion. 3 businesses, the baseball team, a logistics company, and a golf course, make up 2 of the $2.3 billion. 300 million is his 4 mega mansions and his stock and bond portfolio. So this is common knowledge in the billionaire and the wealthy community. And for those who want to transition from being, I'm worth 100,000 or I'm worth 500,000 to wanting to be worth multiple millions and hundreds of millions, you got to do what the wealthy 100 millionaires are doing. And they own boring businesses, private businesses, and they own real estate.
Yeah.
So that's what makes me optimistic. That information is now getting out there, and people are realizing that entrepreneurship and business ownership democratizes wealth creation in this country.
There's those words. I love those words. I love it when somebody figures out a way to weave into a conversation, democratization of the capital markets. That's like, it's so sexy. Yeah, that's because you're on that CNBC. You use those big words like that. So. All right. So that, okay. And that is actually a really great segue into why you started your, and I have to ask where this name came from, right?
I love it.
So, antimatter, because
yes.
I mean, you're a superhero. Is that right?
Or a villain, one or the other.
A villain.
You're gonna love.
Whoever owns the antimatter is the one that wins, right? That's the thing. So
you are going to love this story. Let me just tell you. So first of all, I've been doing antimatter for free for 20 years. So I finally figured out how to scale what I was already doing. Okay. So let me tell you, I'm going to tell you what antimatter means last, because then it'll tie it all together.
Okay. Okay.
The problem that I was noticing is my day job, Wall Street for 12 years, and now venture capital for 10 years. All of my investors on the venture capital side are rich white people. All of my clients at Goldman Sachs and Deutsche Bank were rich white family offices and institutions. What I noticed from them is that they're making 10, 20, 30% returns a year in their portfolios, right? In all of these real estate and private businesses and whatever. And what I noticed in the athlete and entertainment community is that 80% of them were going broke, but 100% of them had financial advisors. So I was like, wait a minute, how can 100% of you have financial advisors and 80% catastrophic results from that professional that you're hiring? I said, what other industry can 80% of the people have catastrophic results and it not be some bells ringing and some alarms going off? What if 80% of the people that went to Fulton Grady Hospital here in Atlanta died after visiting? What if 80% of the people that, ate at a restaurant got food poisoning? They would shut the restaurant and the hospital down. But there's no huge outcry for these athletes because they're young and they're Black and they're celebrities, and it's just a whole bunch of reasons, right?
And they go like, oh, they just don't know
it's their
how to
fault.
manage money. It's their
They
fault. They
spend
don't.
too much.
They spend too
So,
much. They get there, let their friends buy friends cars, that kind of
yep.
stuff.
So what I did was I let me put a placeholder on that thought because I'm going to go there in a second. The second thing I noticed was that all of these athletes had business managers. I said, what's a business manager? Someone to manage and make your business decisions while you're busy playing your sport, right? But the business managers had, you're going to love this, Karen, no experience in business. Now you tell me who would hire someone to make decisions on their behalf in the subject matter that that person had no qualifications, training, or experience doing? It's their friends, or it's an accounting firm that does their bill pay and their taxes. Now that's managing their real estate investments and their venture capital investments. They have no experience in this. A bookkeeper and a private equity guy are two different things. The athletes don't know the difference. So I spent 20 years teaching athletes. The presentation that I just showed you is actually a presentation that I make to financial advisors on how to stop their clients from going broke. I had to break down why their clients are going broke. And I tell them the same thing I told you. Your system works for 99% of people. Athletes are the 1%. They don't retire at 75. They don't spend $50,000 a year. They live for 40 to 50 more years, where your average retiree spends 50 grand, retires at 75, and they live for another 5 to 10 years. Yes, you can put them in bonds. You can't put athletes in bonds. They spend too much. Of course they will. If I had $10 million and I was 35 and retired, I would spend more than $50,000 a year too.
Absolutely.
Right? So that's logical. So I'm educating the financial advisors. I'm educating the coaches. I even allow the athletes to co-invest with me, right? I'm leading to why I started Antimatter Business Partners. One of my Jewish clients said to me, and I mentioned Jewish for a particular reason. He said, Rashaun, I appreciate you getting us 30% returns every year, which is fantastic. I'm in the top 1% of all VCs in terms of my returns. But why don't you do more to help these athletes who are going broke? Like, these are your own guys. They're like from your community, right? And I was like, what else can I do? I'm already teaching them. I let them dip their toe and invest with me. Their financial advisors this and their business managers that. And he looked me right in my eye and he said, if 80% of Jewish guys were going broke, we would do more.
Ooh.
So I spent the next year figuring out how to do more. And here's what I figured out. There are 3 levels of people that work with athletes and entertainers, their careers. The top level, call it tier 1, are rich team owners and business people who they meet as athletes. And the rich people give them strategy and access to things. Think of what Ben Horowitz did for Nas. Think of what Michael Ovitz did for Magic Johnson, right? Like, a rich guy is taking that athlete under their wing and saying, hey, I'm going to introduce you to all of these opportunities and these people that's going to really help you out, right? Michael Rubin from the Sixers is doing it now with a lot of rappers, right? But they don't help execute. They just help them expose and strategy stuff. Then the middle tier are like the lawyers and the agents. These are specialists who get paid to do a particular thing in a job, and they get paid pretty well. They're qualified for that. But then there's that lowest tier, that tier 3, where there's low expectations and there's low pay. And those are people like the bookkeepers, the bill pay, the business managers, and the financial advisors, where regardless of the performance, they get paid the same. Portfolio's up 15%, I make my 1%. Portfolio's down 15%, I make my 1%, right? No other job on the planet where you get paid the same regardless of your performance, other than a U.S. Postal Service worker, a weatherman, and a financial advisor. Okay. So I think all three tiers are necessary because the rich guy isn't going to do the blocking and tackling that the lower level guys are doing, right? But what's happened that messed the whole situation and the dynamic up is the low level people were starting to give the advice like they were the billionaires. Hey, I know I only make 60 grand a year and I've never invested in real estate or private equity before in my life, but you should put $1 million into this real estate opportunity that I didn't do the due diligence and that I'm not putting any money into. So what I decided to do was, how do I go from where I am, that top tier, and influence these guys at the decision-making level? Because I'm giving them the strategy and the access all day long. So I started a business management firm to go and offer business advice to athletes, which was a huge step down. I'm way overqualified for this, by the way. So what we did was we told guys, we're going to do this different than anyone has ever done it. We won't recommend anything you invest in unless we're putting in more money than you. We have a full due diligence team with a track record of investing. We're already wealthy. And we let you set your own price because we don't need your money. And anything that we invest in, we educate you why we invested in, and we're trying to teach you to do it for yourself. We're going to ultimately help promote you from athlete to becoming the general manager of your own finances. And we're going to help you create your own private equity family office. And we're going to name it Antimatter Business Partners. Why would I name it Antimatter? Antimatter is a very rare substance. When combined with matter, creates this huge source of energy that can power a rocket to the moon with just this amount, or an atomic bomb. But the reason why it hasn't been done before is because the technology to harness just this amount right here has never been invented until now. So we like to call ourselves antimatter because Black wealth, athletes, entertainers, businessmen have never gotten together and combined their collective relationships, resources, and wealth and investing power. And this is either going to go to the moon, or, excuse my French, we're going to blow this shit up down here because it's not working for us. So we call it antimatter.
I
So
like
that's the
that
story.
so much. Golly. And trickle it down, man, because part of what I deal with in getting this out and lifting up folks that to believe that they can start to have an impact, even if they don't think they know enough to be an investor. Oh, I don't have time to learn. Oh, I don't have enough money to invest. Oh, I'm not smart enough to invest my own. I'm too old to start investing. What's the point? My business is my investment and my retirement. That's enough, right? And there's so much more they can do, right? It's a different scale because it's not, the entertainment kind of wealth that comes when you break through or
Right.
you have outstanding performance. But, I've had, whenever I would speak on this, I would have millennials that are making, I don't know, $100,000, $200,000. They're working their way up the corporate ladder, and they don't want to invest in their 401k. They don't want to invest in the stock market. They see that Bitcoin and that stuff's crazy. They might have done a little bit of it and made a little money, but they're not doing, it's not long term.
Yep.
Right? They're shut out of the real estate. And so I'm feverishly putting this education together so I can bring a whole new generation that, as in another 5-7 years, and then other ones that are just out there that they have the potential to unlock. There's so much wealth. The thing is that so much money has come down from the federal government, and going back to what we talked about after 2020, and private money, corporate money, Google, and all these things. They threw so much money into these funds to help diverse founders become better at being in business so they could be better equipped to go raise capital. And no effort is being done to bring more capital to the market. And
Right.
so they're all knocking on the same doors that were there 5 years before that, right? Which hasn't changed a lot. And we all know what the complexion of most of that money is, right? And so it's like, this is an opportunity. And when I build this right, then it's going to be something that'll be a tool that places like the Atlanta Urban League can use to educate their community at large. They're doing a lot with the entrepreneur side, but and just all ships rise, right?
Right.
So you're working on the power of the money at the top, and then I'll meet you in the middle with my bringing the folks up from the Midlands.
Well, I love when the collective conscious decides to fix something that seems to be broken. But I don't like when people start to come up with lazy solutions and in like things that just don't work because they just don't understand the dynamics. Let me give you an example. Karen, what percentage of NBA players would you say are Black?
Oh shoot, I would. No, I'm guessing at least 90%, maybe
Yeah, exactly. Like
95.
90. Do you think this whole happened overnight? This has been happening
No,
since
yeah.
the 70s, right? Okay. So put a placeholder in that. What percentage of NBA players do you think are from Pakistan?
I don't know.
Less than 1%, right?
Yeah, I was gonna say 1% or less. Yeah.
Now, what if the government said, or all the people from Pakistan said, the NBA isn't fair. You guys discriminate against people from Pakistan, right? We need to be better represented in the NBA. And we're going to launch a fund, multiple funds to fund Pakistani kids in high school who want to make it to the NBA. When do you think you'll see the results on that?
Yeah, decades.
Decades. So now let's turn this around to tech. People know that in the NBA, it takes years to change the diversification of the NBA because Black kids in the hood have been playing basketball exclusively for 40 years. With no money, that's all we did, right? Basketball hoops everywhere, right? Our heroes were basketball players. Our high schools and elementary schools had basketball teams. They're AAU teams. We wore basketball shorts, and our favorite shoe was a basketball sneaker. There are basketball video games, and there are posters on our wall with basketball players. Now, everything that we focused on was basketball. So, of course, we're 90%. I know communities where everyone's focused on being doctors and lawyers. Guess what? 90% of them are doctors and lawyers, right? So that's what it is wherever you focus. So let's say we wanted to change these statistics in tech, where it's 1% of Black founders get venture capital. First of all, let's look at the high level. Only 4% of companies get venture capital, okay? Secondly, was there an outcry of Black founders who had tech startups 10 years ago who were out here looking to raise capital? I'm not so sure about that, right? I think it's more popular now because people are exposed to it. Like people are like, I want to be like all of the guys who have these billion-dollar tech startups, but I don't overwhelmingly see the software engineering departments or, programs at Georgia Tech and Stanford being dominant by Black kids. I still see it as Indian and Chinese, to be honest with you, right? Those are the vast majority of the guys. So the last thing I'll say is before anyone raised $1 of venture capital, and I think we spoke about this in 2019, so I apologize if this sounds duplicative.
No, it's good.
They put their own money in their startup or they build some type of software. I just got off a Zoom call with a Black founder from Gas Valet. He has a valet service and software that he uses to turn every gas station to like a valet service where you pull up, you don't have to get out, right? Just like New Jersey does automatically, right? So he is an engineer. He built his own software, which is amazing, right? And he put his own money in. The second round of capital that any founder raises is from family, friends, and you know who the last F is? Fools.
Yeah.
Family, friends, and fools. They raise a couple $100,000 from them. Nobody else is going to give you money for something with a 90 to 95% chance of failure with no revenue. It's only been around for 2 months, right? Other than people that love you and know you and all that stuff. And then the last round of capital they raise before they come to guys like me, venture capitalists, are angel investors. Now, who do these steps favor the most? people who come from poor environments, who don't know any angel investors or have no family and friends and fools with money and have no money themselves, or people who come from rich environments where their uncle can give them $500,000.
Right. I know. That's the thing.
So launching a fund to fund minority startups who can't get family and friends money, who don't know angel investors, is like putting computers in Liberia after Civil War when you have no electricity.
Yeah, I know what you mean, man.
I
I've been
saw
talking.
it. I literally was in Liberia at an orphanage, and it was a room full of computers. The room was dark. There's no electricity. So
Yeah,
you skip 3 levels because you don't understand what's actually happening in the startup community. In the startup community, VCs don't fund ideas.
right,
They fund traction and growth.
right.
The startup is valuable when it has no revenue based on the founder's background. How many exits have they have? Are they a computer science engineer? Are they the smartest person in the country on this subject? Based on the team, and then based on traction. You need that family and friends and an angel round to do that. A VC fund from Google Ventures or SoftBank for minorities, where they set aside $100 million using the same criteria that they use for white startups, is not going to work. Just like if you go to the top college programs right now, Duke, Carolina, Kentucky, and you're like, where the Pakistani guys at? More Pakistani guys. You're going to see all Black dudes. Okay. So that system was the solution wasn't well thought out because the solution came from outside of the industry. It didn't
Just
come
throw
from
money at it.
just throw money at it is philanthropy or whatever. So the diverse founders thing is a lot more challenging because the real issue is the wealth gap. It's not Silicon Valley.
Yeah, I
The
know.
wealth,
Yeah,
the wealth gap. Now, the solution that I think for all of your 20 to 30-year-olds who would prefer to do crypto than the stock market is 2 things, in my opinion. Number 1, buy small businesses. You can go on bizbuysell.com right now and buy a business for $15,000 in your own city. You can buy a UPS store, you can buy a laundromat, you can buy all of these businesses that kick off 50 grand a year, that kick off 25 grand a year, and you keep building from that. You take the cash flow from that, and you don't even work there. So find a business where the owner is absentee and you don't have to run it. Then it's passive and it's not a job. Second, do not become an investor. Become a co-investor. Rashaun Williams is not an investor. I'm a co-investor. I co-invest alongside people much bigger and smarter than me. Right? So if I want to buy real estate, I just bought my first multifamily here in Atlanta, and I found the best developers in Atlanta who put in their own money, who have the best track record, and I convinced them to take my money. I'm a co-investor because I'm not the real estate developer. I don't manage properties. I don't do construction. So I would get taken to the cleaners if I would just put my money into something with no experience in it. So I'm co-investing with someone who doesn't need my money. That's why I had to convince them, who have a great track record. So co-invest with angel investors who are great at tech. Co-invest with private equity guys who buy small businesses. Co-invest with great investors who are investing in the stock market. That's another reason the stock market, the financial advisors don't work, because they're not investors, they're asset gatherers. So it's not like they're picking stock like they used to in the 80s. Like the value of a financial advisor in the 80s was they were stock pickers. Hey man, I'm going to make money on this stock. Now you don't even know what your performance is. The guy isn't picking any stock. He's just dumping you into mutual funds, charging you 150 bips. The mutual funds charging you 100 bips. And it's just blindly investing in stuff. So anyway, so my advice would be buy small businesses and become a co-investor. And I think these young kids will find that they'll make more money with less risk, and it will be a lot more interesting than just going into the stock market or into cartoon pictures of monkeys.
yeah. Well, and that's part of, the whole financial IQ of it all, right? And so that's, you mentioned, because part of it is the greatest source of creating wealth is to be your own business owner.
Correct.
The thing that people, that because it was a secret, let's just say, the next greatest way to create wealth is investing in those successful businesses, co-investing, right? You got the founder, the initial piece that they're committing their stuff, other people that are smarter, know better, whatever,
with more money than you, who do more due diligence than you. Yep.
Right. And so that's where it And that's the breakthrough. That's the paradigm shift. Because even when I talk to people that are business owners and I say, have you ever considered investing in other businesses? And they're like, oh, no, whatever. And it's like, no, you have to understand, that's where the most wealthy do that. They have been doing it. That was the big secret that, they have been investing in businesses all along. There's a reason why they do that when they could be doing just real estate and stock, but they invest in private businesses because they have
Yep.
they just hadn't been telling you about it, right?
Right.
And so part of when I talk to some of the venture funds that are focused on diverse founders and even angel, because even within that gap of angel groups will only invest in a company like at least all of Atlanta. There may be on the West Coast is different, but for the most part, because I've been helping some companies try to navigate that, they almost all want you to have you have to have a finished product with revenue, right?
Yep.
And then, and then you got that, right? And then it's the geography and it's the sector and those kind of things. But those are really the first two things before they'll even consider your application. And
But
so,
Karen, I'll flip it on you. Let's say you're the number one Black startup in the country. You're crushing it. Do you want money from a VC fund that just popped up to only fund Black startups, or do you want money from Andreessen Horowitz? You're going
right.
to scoop right over that fund that was set up for the best Black startup. Just like if I started a school for Pakistani college players to play basketball, they're going to skip me and go to Duke. They're going to go to UNC in Kentucky. They're not going to go to the school for Pakistani guys to help them increase their diversity numbers in the NBA. They want to go to the school that Michael Jordan went to. So even if we set these things up, it still won't attract the best. So that's why we have to go a little earlier. I hate to keep going back to that subject, but it's really a wealth gap issue, and it's
Yeah.
not a throw money at the top issue because it's nothing at the
Well,
top.
I've been seeing some interesting models for this, and that's the thing that I've been. Every state has what they call, like in Georgia, it's the Invest Georgia exemption, right? You're
Yep.
familiar with that. That's where you can
Mm-hmm.
directly public offer to people in your community to
Yep.
invest.
Mm-hmm.
And so it's been around for a decade. It was before the Jobs Act
Oh,
in
okay.
Georgia. We've
Mm-hmm.
had 100 companies that have raised capital. It's been like dentist office,
Yep.
breweries, maybe a little real estate thing, mostly small businesses kind of stuff. And our Secretary of State is very, because I was a speaker at the FinFit and I was talking to him about this because, that's my thing. I've been like, we can do this in a community based where people that may not be at the high level that you're talking about, but they believe in, you can reach outside your circles of, not having access to capital.
Yep.
And this is the community model, and it's popping up in different areas where it's more, people come together in smaller amounts of money until they get comfortable with it, and they can do bigger amounts of money, and
Yep.
it's been popping up. And so but we're so proud that we have 100 companies in 10 years that have done it. And I thought that was abysmal. Like I thought, how can we only have 100 companies in 10 years in this program? But we're like leading the way. It's because governments don't market. They don't know how to market. They don't know how to
Right.
explain. They don't know how to
Right.
do any of that kind of stuff. And so even though it's out there that what a church could all throw in and help that business get that young startup get to that next level of getting it fully developed, getting their first customers so they could potentially knock on the door of some of these other money things. It's just
Yep.
that. And so, like I say, we have common goals and objectives. It's just, of, you know unlocking the wealth that's on the sidelines,
Yeah.
that's not being utilized in the way that it could, thinking differently about what a paycheck is, and taking that money, and putting it towards like this, like the crowdfunding strategy that I kind of come back to that, and I changed mine, and mine was all on the higher accredited wealthy, you know the millionaire next door that wants to become a multimillionaire that would become an angel investor. That was where I was focused for years. But then I
Yeah.
realized there's this potential for this grassroots that said, and it was actually really Jason Kokonis that talked about it on a podcast, that I was like, I never even thought of it that way. And he says, if he could go back and I could do, he was talking to the founder of Seed Invest. If I could go back and I could do, if I knew what I knew now and I could talk to my 20 something self, I would say I wouldn't go start that first business, where I just slugged it out and then it really didn't do much. I think it was like a, lawn care business or something. And he says I would have gone ahead and got the high paying tech job or whatever. And instead of putting $500 a month into a 401k that wouldn't get matched for 5 years, I would put $500 a month into crowdfunding companies that I thought were doing something interesting, because they would have at least gone through some screener through the Reg CF platform of, licensed FINRA people that had
Yeah.
to screen them. Right. And he says, and in that 5 years, I'd be about 30,000 that I would have invested. I would have invested in 60 companies. Right. And if you just do the math, even if I'm bad at it, right, if you just do the math of, out of 10 companies, which ones hit it, which ones lose, all that kind of stuff, and even give a benefit of the worst doubt that Reg CF's not going to perform as well as established regular companies, right? I would still have at least 4 companies that had produced 5 to 10x my money, right?
Mm-hmm.
And I would have Midland companies that um were back, had done this, and I would have a lot more than the 30K of what would have been matched in my 401k, right?
Right.
And I
That's
would
right.
have great experience of watching these companies maybe going in and investing more on the ones that were making milestones. So by the time I came out of that, and now I'm making maybe 250, I'm ready to put
Bigger
five
check.
grand or 10 grand into a company and start to build it, kind of like you were talking about the five, it's not just a straight up interest thing if you were talking about with your daughter, but it's a way to get the sea legs to be able to know how to choose what works, because every time, even now, angel investors, when I learned, I would be talking to these angel investors, and the angel investors would be like, well, how'd you learn about becoming an angel investor? Oh, I learned by losing my money. Well, that's a horrible way to learn how to be an angel investor. There's no, because that was like there was no training out there, and it was like they kind of just invested because somebody else said invest and
Yep.
whatever, and they, and then they would learn like, oh, I needed to ask these questions. Oh, I needed to look at this on their financial forecast. Now I
Yep.
understand, with this and that and the other stuff they would learn. But instead of losing by 50 grand investment, you're losing $500 investment.
Yeah. Yeah.
Right. And
Mhm.
so it's an easy way to kind of, so that's, really the course, the book talks about financial statements and stuff like that, but now it's actual digital course to go through and say, this is what you look like. This is what I do when I look at financial statements for due diligence purposes. And,
Mhm.
and being able to build that up, because nobody's really teaching that at the grassroots level to build this next generation of people that like someday will be investors in your funds.
Buying your book right now. I don't know why I didn't buy it before, but Inside Secrets. Let's go.
All right. Okay. Then we'll have to tell me, what I missed and for
Okay,
the
I
second
got you.
version. Right.
Kindle, not going to do the paperback. I prefer paperback. All right, great.
All
Okay.
right. Well, so here thank you so much for your time. We're a little bit over. What any last gold nuggets you want to share with the audience before we go? Because I didn't even get to talk about the exciting board that you got added onto and all of that. I wanted to be like, what's the difference between a public and a private board? But that'll be for another day when you're on like 5
fun,
boards,
fun and
3
no
years from
fun.
now.
That's the difference. The private stuff is way more fun. The last thing I would say, I just want to really reiterate that not all, if anyone tells any of your angel investors that private companies are risky, not all private companies have the same risk or return profile. So early stage companies are the riskiest. We underwrite, 90 to 95% failure rate. Takes 10 to 15 years to get a return on it, but you can make 10, 50, 100 times. That's that 50 grand to $20 million, right? In Coinbase that I mentioned to you. So you need to plan on doing 20 to 30 of those a year if you want to really make 1 or 2 exits, on the back end. So that's first and foremost. Consider that a high school athlete that wants to go to the pros. Now, the level above that is called growth stage, series A, B, and C. And that's less risky, 50-50 chance they make it in 4 to 6 years. You can make 4 to 6 times your money. And then last but not least, late stage is the safest in private markets. They've already have product market fit. They're already north of 100 million in revenue, already worth more than $1 billion. These companies, we tend to make 1 to 4 times our money in 1 to 4 years, 90% of the time. So what I do is I do 50% late, 30% growth, 20% early. I make 1 to 3 times my money in years 1, 2, and 3. I make 4 to 6 times my money in years 4, 5, and 6, 50% of the time. And then I make, I don't know, 10, 20 times my money on 5 to 10% of my portfolio in years 7 through 10. But I get cash flow annually because I'm staggering it by stage.
Yes.
My check sizes are really small for early stage, 10K, 25K, late stage, 250K to 500K, because I'm going to get 1 to 3X in 1 to 3 years. So that's how I get cash flow, and I live off of passive income. And separately, I buy the boring businesses because I get monthly dividends because I own the whole business. So if a business does $1 million in profit, I pay 3 or 4 times profit from it. And I'm getting 20 to 30% returns every year on that using that line of credit. And I'm getting cash flow to pay all my bills. I'm taking long-term bets in the venture capital stuff. And that's how you use modern portfolio theory to invest in private businesses. That's the last
excellent. No, that's really, and it's so it's refreshing because this is something brand new with the digital course. I came up with this what I call the angel profitability blueprint.
Mm-hmm.
And because you have to nurse people along on they're not ready for the big, like what you just laid out, like that would be, that would blow their mind, right? Because they're just like, so the idea is in 2 years you're going to invest in 10 companies.
Mm-hmm.
And how much depends on how much you have. I'm
Yeah.
targeting people that have money sitting on the sidelines because they were going to do real estate, but they got shut out of the market, so they got some cash.
Yeah.
And with the idea they're going to do something just like you say that gives them income now, so it'd be like being in a rental property, but then and then mid ones that they're just they're the ones that you're not really sure what's going to happen. They're growing, but then also the later one, because with the Reg A Plus companies now, it's not quite like going into some of the ones that are like the almost public one, but Reg A Plus is it's just not a Coinbase. They're not famous companies that are doing straight up IPO.
Right.
These are companies that if they fall, they're doing 5 to 10 million in revenue, and they miss their, I call them the Midland. Well, they had an angel round, but they didn't get a VC round. Now they got a new product to come out with, and they need to raise money, and they can't go. They're too small for private equity funds. They're not wrong industries, too slow close for VCs. Where do they go? Well, they go to their customer base, or there's investment bankers out there. There's Wall Street people out there that if a company's queued up to be qualify as a Reg A Plus, that they'll put money into that. So they're co-investing with institutional money on a Reg A Plus, and they potentially would have their exit in that 2 to 5 year time frame. It's just not as big, but it's a place for a retail investor to find something that they're somewhat comfortable with, because they do have to have SEC audited financials. And so it gets into a comfort level of somebody that might be a stock market investor that does their own analysis, right? And so that's that's what I'm building. So
love it. Love it. Well, congrats on that. And again, congrats on your book and everything you're doing. I'm so happy to be here, and I appreciate you inviting me back.
And I'm just so unbelievably honored that I'm the only other podcaster that you've been on. That is just phenomenal to me, Rashaun. So I like, thank you. I already felt just special just being in your circles, and now I'm really even more special. So you've made my day, you made my week.
It's good seeing you.
All right, thank you so very much. Have a great day. Have a great holiday, and I will let you know when this is live.
Okay, take care. Bye.